Everybody. Today we're talking about the employee retention tax credit for childcare providers. My name is Olga Odhiambo. I am a CPA and I work exclusively with owners of childcare centers all over the country. A little bit about me. I am a CPA, and like I said, I specialize in the early childhood education industry. Personally, I love the industry because I have been a client. I have a 7-year-old boy right now. And if it wasn't for the industry providers, I don't know what I would have done, especially in his earlier years. Again, I really appreciate the high quality. And as a mom, that is a very emotional topic for me. As for my background, I have a Bachelor of Arts in Economics and a Master of Science in Business Analysis and Finance, but I'm most proud of my CPA and also the fact that I'm a certified tax coach. This just means that I help owners of childcare be more strategic with their tax planning. I'm also an IRS representative, and as mentioned earlier, I'm a proud mom of an 8-year-old. Now, let us understand what the employee retention tax credit is. This is a tax credit that was offered by the IRS to help support businesses that were impacted by COVID-19. As you all know, COVID-19 had quite a large impact on businesses. And it wasn't that the stress came from the fact that we did not know what the massive impact of COVID-19 would be. So on the government side, they wanted to support employers who were able to maintain their employees on their payroll. Okay, there are governing rules. And if you remember, during the COVID-19 time period, the laws were changing every so often. So the CARES Act was introduced in March of 2020. And that, if you recall, that's when we started feeling the impact of COVID. And then this was modified by other laws in 2021. And then again later with the American Rescue Act of 2021. So what does this mean? It means that the law regarding the employee retention tax credit kept evolving. Right? At some point in 2020, we didn't know whether we qualified. And then there was a lot of, funding opportunities like the PPP loans. Government had to clarify whether you could still get the PPP loan and, qualify for the employee retention credit. So there's a lot of evolving rules within the ERC, especially between 2020 and 2021. However, now that we're in 2023, the law is kind of settled and we have a good idea of what the employee retention tax credit is and who it impacts. So let's look at what kind of wages count for the ERC. Okay, these will be your employee wages. And here we are talking about businesses and also the non-profit organizations. The only kind of employers that don't qualify for the ERC are government type of entities. But if you're a business owner, as well as a non-profit organization, the wages you paid your employees during 2020 and 2021 may qualify for the ERC credit. The other thing that you want to take into account are the health insurance costs. And to be specific, these are the employer costs. So whatever you pay towards your employees' health insurance costs, that may qualify for the ERC credit. Keep in mind that the employee's own contribution is not part of this calculus, okay? If you happen to own a business and you hire relatives, such as brothers, stepbrothers, sisters, parents, or children, it is very likely that their wages will not qualify for the employee retention tax credit. So you want to be very careful when determining what qualifies and what doesn't. So again, relatives' wages do not qualify for the ERTC credit. In certain cases, however, spouses' wages do count, right? So it's a bit confusing, but just think of your lineal descent, your brothers, your sisters, your uncles, their wages might not count. But if you do have a spouse, your spouse's wages do count. The only time it doesn't count is if the spouse also owns the business. So if you have a spouse who's not part of who doesn't constructively own the business, but actually is an employee of the business, their wages will count. I'm sure you all remember the PPP loan. These were the loans that were issued to employers to assist with covering payroll during the pandemic, okay? So this was a benefit, and it actually became a benefit because this loan automatically became forgiven if you applied for the forgiveness. So if you applied for the forgiveness and the forgiveness was granted to you, you cannot use the same wages to claim for the employee retention tax credit. That means there's no double dipping. So if you benefited from the PPP loan, you have to exclude those wages that were paid, that were used to pay for PPP. So everything else outside of the PPP would qualify for the employee retention tax credit. So if you all recall, the PPP loan would cover a period of 6 months, correct? And so if you were to take care of the PPP forgiveness and actually offset the 6 months worth of wages, then whatever's left off may qualify for the ERTC. And to just be a little more specific, if you recall, PPP loan forgiveness actually indicated that only 60% of your loan should have been from wages. So if you used only 60% for your forgiveness and maybe the other 40% for working capital like rent, utilities, it means you have even more funds to apply for the employee retention tax credit. If this is too complicated, just remember you cannot double dip. ERTC wages should not be commingled with the PPP loan wages. Now, how much can you claim for an employee? For 2020, the IRS told us that you could claim up to $5,000 per employee for the entire year. So for example, if you had 10 employees on your payroll in 2020, those 10 employees could qualify up to $5,000 per employee. The actual amount of ERTC depends on the actual amount that you paid, okay? In 2021, remember the laws were evolving during this time. In 2021, you could qualify for up to $7,000 per employee per quarter. So in 2021, you will notice that the government was way more generous, giving us way more money and over a shorter period of time. So and this again depends on how many employees you had on your payroll and what you actually paid them. Okay, so just keep that in mind, $7,000 per quarter per employee. And this was in place up until the quarter three. So Q1, Q2, Q3, $7,000 per employer. So if you've seen this, I would say commercials saying that you can qualify for up to $26,000 per employee, what they really mean is that if you had the employees in 2020, 5,000 would qualify you. And in 2021, up to 21,000 would have you qualify. But not just that. In quarter four, there's something called the Recovery Startup Business. And I'm going to talk about it later in our webinar. But pretty much this means that those businesses that started around early February 2020 may also have the opportunity to qualify for the ERTC. So as you can see, there are many opportunities for your business to qualify for the ERTC, but you have to pass the tests that the IRS have put in place to determine whether or not you qualify. So let's look at these tests. How does your childcare business qualify for the ERTC? The first one is the gross revenue test. And what does this mean? So basically, we want to see how much money your business made for each quarter in 2019. And then we want to compare the 2019 numbers with 2020. Essentially, what the government is looking for is, did your business suffer because of the pandemic? And the way they quantify this is to look at the 2020 numbers, comparing them to 2019. And if your business, the revenue of your business decreased by more than 50%, more than 50% means from 51 and above. So if you had a dip in your gross revenue by 50% for each quarter, so you want to compare quarter for quarter. So you take Q1 of 2019, compare that to Q1 of 2020. If you see a reduction in your gross revenue, then you may qualify. Okay. The second way to qualify, again, still on the gross revenue test, would be in 2021. Remember, I mentioned that in 2021, the government here is more generous. They're not now looking for a 50% decrease, they're looking for a 20% decline. So this means that your revenue, you don't have to show up. This is a smaller decline in your gross revenue. And we are comparing the numbers between 2019 and 2021. And just a caveat, because there's a little more flexibility here, you may actually choose to compare these revenues with 2020, assuming that there's a decline between 2020 and 2021. This all depends on your specific circumstances and facts for your business. So it's a very good idea to consider all these facts. So just like I said, in 2021, we're looking for a 20% decline in your revenues, and we're comparing them to 2019. Keep in mind, you may also compare them to 2020. The second test is called the suspended operations test. What does this mean? That if you review, your local government, was there an order from your local, the governor or, the local county? Was there a governor, an order that required your business to be shut down? And it's not just a total shutdown. It may have required you to partially shut down. Let me just give you an example. It was during the pandemic that businesses were asked to make accommodations for social distancing. So if you had to reduce the number of children you can accept because of the fact that you have to space them out, or convert some classrooms to be COVID compliant, that may have led to a partial shutdown, because here you've been ordered by the government that you either shut down your business or manage it such that you can run the business in safely. So whether it means having fewer kids in a classroom, having fewer teachers, or just making accommodations for the COVID-19 virus. Now, for the partial suspension or total suspension test, remember, we're only looking at the period of the suspension. So number one, the order has to come from a local government authority. And number two, we're looking at the wages you paid during that time of suspension. Okay, so we all know the whole country shut down, and this thing typically it affected the whole world essentially. But a true government order should come from your local authorities, and you can Google this information or go through the government reports that were giving directions to your local businesses whether or not they can shut down. So you need a government order, specifically a local government order, and that order must have affected your business. Okay, so a lot of childcares were indeed shut down. Some of them were still open to serve members who were considered essential workers, or maybe your childcare was considered an essential business, but you had to still operate at a reduced capacity. So if you are in that case, then you may qualify for the ERTC. there is another twist here. For you to actually get the credit, you have to demonstrate a more than nominal impact of the shutdown. So what does this mean? That maybe your gross revenue was reduced at maybe 10%, or you had to hire fewer employees because now you have fewer kids in a classroom, and therefore the employee hours have been reduced by more than 10%. So it's not just the shutdown, it has to be government, it must have been a government or local government requirement. And then you also demonstrate that you had a more than nominal impact on your business. The third way to qualify for the employee retention tax credit is if you started a new business in 2020. Okay, so if this was a new business, you may qualify for the credit. And this particular test only qualifies for 2021, the third and the fourth quarter. So if you're a new business that started in 2020, you probably won't qualify for the 2020 decrease because you don't have 2019 revenue to demonstrate. But for the 2021 test, you may qualify because now we're taking the 2021 gross revenues, you're comparing it to 2020. And if it's a new business, you're almost guaranteed that you might get something for Q4, okay? A little complicated, your head might hurt, but just remember, 3 ways to qualify: gross revenue test, my business suffered as a result of the COVID. Number 2, there was a government ordered shutdown, and as a result, my business suffered. And number 3, I started my business in 2020. And because you are starting it in precarious circumstances, your business may still qualify. So another thing to keep in mind is that with the calculation for the employee retention tax credit, the IRS has something called aggregation rules. So aggregation rules apply to situations where business owners own more than one entity or more than one business. Classic case is you have 2 childcare centers, 2 different locations, 2 different EINs, but you own them 100%. The rule here is that you need to own more than you need to own more than 80% of control of that business. If that is the case, you have 2 businesses, and you want to know if those 2 businesses qualify for the ERTC, the IRS will consider those businesses as one. Okay, so when we are comparing the reduction in revenue, the shutdown, or whether or not you're a recovery business startup, they want to consider it as one business. It's called the business aggregation rules. So when they look at gross receipts, they're looking at gross receipts for the 2 businesses combined. So they're going to compare the 2 businesses combined 1 year over another, quarter over quarter. So keep that in mind, that if you have more than one business, the IRS might use the aggregation rules. And aggregation rules can either help or hurt your ERTC application. An example is if you are in one particular location and one business wasn't hurt as much by COVID and yet another one was hurt, we are going to aggregate these businesses to know what was the net impact of COVID for the 2 businesses. We're not going to consider those businesses as separate for the purposes of ERTC. Now, let's revisit the gross receipts test example. Remember, we mentioned that in 2020, you had to demonstrate a more than 50% decline in revenue. Okay, I have an example here. And here we're just comparing one quarter to the next. Okay, so you're going to have your numbers right where you're aligning Q1 of 2019 to Q1 of 2020. What we want to know is that in Q1 of 2020, did you experience a decline, more than 50% decline in gross receipts? If the answer is yes, you may qualify. And during the same time, did you have employees in your business? The answer is yes, then you qualify. Now, for 2020, the government is willing to pay you up to $5,000 per employee. The $5,000 is actually, it's based on the actual amount of money you paid these employees. So, for example, if you had an employee that was paid up to $4,000, the ERTC calculation will be based on that $4,000. It's actually, you get 5,000 or less. So in this case, assuming we have an employer with 10 employees and each employee got paid more than 10,000 for the year, each employee is eligible for $5,000. So if you had your 10 employees, they would qualify for a maximum of $50,000. This is a credit that you get, and it's it's cash in your bank pretty much. This is money that the IRS will refund it to you. Think about it like when you file for your regular taxes and you get a refund from the government, right? It's working in the same way, but it's based on payroll wages. So this is an actual cash in your bank account. Now for year 2, the government is very generous here. So again, remember the laws are evolving, Congress is coming together, we are still unsure of the pandemic. Congress comes in and says, for 2021, the burden is a little less on the business owner. For now, you just need to show us that you had more than 20% decline in your gross revenue. So we have an example here in a quarter where you have 2019, you want to compare those wages with 2021. If you show a more than 20% drop in your gross receipts, then you qualify. The other thing you want to be cognizant of is that you're qualifying for up to $7,000 for the first 3 quarters of 2021. So that means that each eligible employee may qualify for up to $21,000. So for 10 employees, you get $210,000. Very generous compared to 2020. But again, do the test. You have to do the test to make sure that you qualify for both years. One thing that I may mention here is that even when you're calculating the ERTC for 2021, and there's an opportunity where you get a better outcome by comparing 2021 and 2020, the IRS will give you the flexibility to do that comparison. So instead of comparing it to 2019, you might actually want to compare it to 2020. Again, we run the numbers to make sure that you get to maximize the credit to the childcare business owner. So what does suspended operations mean? Like I said, it has to be a government order, right? And you need evidence of that. This is an employee retention tax credit. It's a credit that's going back to business owner. IRS may want to, if you happen to be audited on your ERTC application, you want to have all your documentation in place. So one way is to make sure you have a copy of that government order, right? And the suspension of operations can be either full or partial. You may have just completely shut down your childcare for a time, or it may be a partial suspension where you're making accommodations for social distancing, or you're just opening it up for, the nurses, the doctors, the essential workers that were helping us run the economy while the whole country was shut down. So, like I said, government order has to come from the government. Number 2, if you still paid wages during the time of full or partial suspension, those wages count for the employee retention tax credit, okay? And number 3, Yes, you shut down. Yes, you got the government order. But now the third thing we want to demonstrate is that there was a more than nominal impact on your business. Classic case of example, you had to take in fewer kids because of COVID. And if you can demonstrate that when you compare that, that period with the previous year's period, your business actually suffered because you have fewer kids, then that is one way to demonstrate that that the government shutdown affected your business. Another way is if you had fewer employees, so you have your workers working fewer hours because of course there are fewer employees, that can demonstrate that your business suffered during the suspension. But again, government orders is very essential for this. And the last way to qualify for the ERTC is the recovery business startup. Now, the key questions to ask yourself is this an expansion or is it a totally new business from the one you had in existence? So, for example, some people may have determined that they wanted to expand their businesses. If you already have a childcare business and you want to open a second location, that may be interpreted as an expansion rather than an entirely new business. It is really subject to the interpretation of the law. Some people are more aggressive and will still go for the credit, even if it's just a new expansion for their business. But to take the more cautious step, I would say if you already have an existing childcare and you open a second location, to me, that is an expansion of your business. But if you own a childcare business and now you are opening a coaching business, even if that coaching business is in the childcare industry, that is an entirely new business, and that will qualify as a recovery business startup. We call it the RSB, that is recovery startup business from the IRS standpoint. Another question you want to ask yourself is, when did this business begin? It must have started after February 15, 2020. Okay. And remember, we talked about the comparison of 2020 and 2019. In this case, you may not qualify for the 2020 ERTC, but you may qualify for 2021. Remember, 2021 is way more generous over each quarter. So you want to look at, is this a new business? When did it start? And can I compare the 2021 gross receipts versus 2020? And if that's the case, you may still qualify because you're a recovery business startup. Now, the one thing to keep in mind is that the RSB provision allows you to get ERTC even in the last quarter of 2021, even in Q4 of 2021. Okay, so that's kind of interesting because Congress decided to stop the ERTC at the end of September of 2021. Then they came back and made an accommodation for those people who started their businesses in 2020. And what's beautiful about this RSB is that you can actually get up to $50,000 for this in the last quarter of 2021. So I know it's going to hurt your head a little bit, but just think about it. If you started your business in 2020, and indeed you can prove that your business was affected by COVID, you can actually qualify for the fourth quarter, all the quarters of the year. But there's a dollar limit of 50,000. So it gets a bit complicated, but every employee will qualify for 7,000, but you can only qualify them up to 50,000. So if you had 10 employees, you're not going to get 70,000 in this case. It's going to be capped at the 50,000. But I think it's better than not getting anything. So consider when did the business start? If it's a new business, is it related to your existing business? If it's not, you may actually qualify for more money for the COVID. Couple of things that I want to mention, that it's very important that you, when you're applying for the ERTC, that you meet the three criteria, the three tests for qualifications. And so, you know, my firm can help you screen this out. Look at your payroll records by quarter. If you miss one test, let's go to the next test. Did you shut down? And if you did shut down, did you have a government order? Was there a more than nominal impact? If that's not the case, is this a new business? Is there any way this business can qualify based on the requirements for the recovery startup business? If we do move forward, it takes us a little bit more over 2 weeks to determine whether or not you qualify. Again, we probably need some payroll records from you. And the way the ERTC works is that we'll go back and review your payroll tax filings. This is normally done through your 941s, the quarterly returns that you do with the IRS. To submit for the ERTC, all we do is amend your 941s and send those to the IRS. The IRS, again, we have no control over how long the IRS takes to process your ERTC. But as soon as they approve it, you will get a notice from the IRS, just like you would get a notice on your individual taxes. Hey, we made a mistake on your taxes, or thank you for amending your taxes, and this has resulted in an additional X number of dollars that you get. And once you get that confirmation, you get money into your bank account. Some people have been receiving checks, and some have been having some direct deposit, the money directly deposited into their account. Again, this is money that your business can use to support your payroll, to support your childcare business. So I think it's worth looking into. One thing I also want to mention is that when you hear people telling you that you're going to get $26,000, I would say it's a little misleading. Number one, because, hey, it could be more. It could be more because you started your business in 2020. On the other hand, you will also be required to amend your regular taxes. So if you're an S Corp, if you're on a C Corp, you're going to have to amend those taxes. And so what does this mean? It means, therefore, that there might be a reduction on your personal taxes ultimately. So just telling you that you'll get 26,000 might be a little misleading. It's probably going to be less than the 26,000 because you're going to have to go back and amend your regular tax returns, your business tax returns, and sometimes ultimately your individual, your 1040 tax returns. Because what the IRS is saying is that when you get that credit, it means your payroll costs have gone down. If your payroll costs reduced, it means you had a higher income in those years. And if you had a higher income in those years, then you owe a little bit more on taxes. But because the employee retention credit, it's very generous, right? It's either giving you 50% refund or 70% refund. The last I checked, nobody is paying taxes at 50% rate, right? Your tax rate could be between 13 to maybe 32%. So that delta between what the employee retention tax credit is and your tax rate could actually mean that you benefit from the ERTC, but the benefit is just going to be a little less than the 26,000 that everybody is talking about. There's going to be some nuances to this employee retention tax credit. Just keep that in mind. And I'm hoping that I've explained the tax credit. There's a lot of nuances to it. There's many ways through which you can qualify, but I think it's worth taking a look at. And if you feel your business did suffer during COVID, why not? You might actually, get some money in your bank account and help run your childcare business.
If anyone has any questions, please send them to the chat or just, unmute yourself and ask.
I'm curious to know if, just looking at your numbers, when you looked at 2019 versus 2020, Did you see any reduction in your revenues? I don't know if anybody had that, and if they did, they may qualify for the ERTC.
Seems like people are not sure. No problem. I sent out a form in the chat. It's a complicated bill. There's a lot of nuance, as you guys can see. There's a lot of, but if this or if that. So you definitely want to work with a professional like Olga if you're thinking about filing for this credit. It can get confusing, as all tax things can be. I sent a link into the chat. If you're interested in working with Olga, fill out that form and you guys will be in touch. It's money in your pocket or money in your bank account. So take advantage of it while it lasts. I think it's here until 2025. They're eligible to receive this credit.
Yes, so for 2020, for the year 2020, it will expire in April 15th, 2024. Okay. And then for the 2021 will expire on April 15th, 2025. Okay. So you do have some time, but because it's a little complex, you want to give yourself enough time to get the credit, run the numbers. And if it was me, I'd rather have the money right now than wait later.
Wonderful.
Mm-hmm.
Well, thank you very much, Olga, for this wonderful presentation. Thank you, everybody, for joining. I hope you guys learned something about this government program and how, it can help your center out. If you have any questions, here's Olga's information, her, website. I will be sending out this all in an email as well, so you can get in touch. But thank you very much for taking time to join. Thank you, Olga, for your presentation.
Thank you.